Hi, I'm Tom Selzer from Livewire Markets, and today joining me is Ron Temple, Chief Market Strategist at Lazard, to get his insights on the current outlook for global markets. Thanks for joining us, Ron.
Happy to be here, thanks.
Ron, if we could just start, I think you've said recently you expect increased volatility in the second half of this year. What are the factors you think that will drive that volatility?
Yeah, and you use my own words, but increased volatility as opposed to sustained volatility, we could debate that. But the reason I think there'll be volatility in markets is we're waiting for a lot of data, right? So you've had this, most overused word in the world, unprecedented trade war emanating from the United States year to date. If you go back to January 19th, the weighted average tariff on imports of goods in the United States was 2.7%. As of today, it's 18.6%. So you basically had a nearly 16 percentage point increase. But what's interesting is we have that data, it's public data, but a lot of that increase is kind of a headline increase. The actual billings for tariffs have been much lower. So if you look at June, for example, the actual billed tariff rate was closer to 10 to 11%. So when I say there's more volatility coming, we're waiting to see how are these tariffs going to work their way through to inflation. What are they going to do to GDP growth? What are they going to do to corporate profit margins? There are just a lot of questions still to be answered. And that's leading to a lot of uncertainty around monetary policy, which I'm sure we'll talk about. And then you've still got geopolitical questions, in terms of this back and forth on what is the U.S. position around Ukraine? How will allies in Europe perceive U.S. commitment? A lot of questions out there. And so I don't think this volatility is going to go away, despite what seem to be kind of relative signs of extreme optimism potentially in markets. But there's more to come.
You mentioned monetary policy there. What are your thoughts on the ongoing battle between the Federal Reserve and the Trump administration? And I suppose, what do you think is the best outcome here for investors?
Yeah, so this is a really tough one. I've been very out of consensus year to date in terms of believing that the Fed would not cut rates before year end. And I always have a challenge. I think this is true for any investor or any economist, is trying to think of what is the right policy as opposed to what will the policy end up being. And with the Jackson Hole speech last week from Jay Powell, grudgingly, I think I'm ready to capitulate and say that we might get one rate cut this year. The market, again, saying 55 basis points. I'm not completely sold on even one rate cut. I think if you consider between now and September 17th, you've got another data point in terms of personal consumption expenditure inflation. We've got consumer price index, another labor market report. So there will be more data for the Fed to consider. Markets are saying around a 90% chance of that 25 basis point rate cut in mid-September. Probably going to get it. Partly maybe for the Fed to reduce some of the political pressure from the White House. But we'll see what happens thereafter, because this unemployment inflation data is going to be, again, a roller coaster. One other thing I should have mentioned, I focused a lot on jobs, but the inflation story is the other one. I mentioned raising the tariff by 15.9 percentage points since pre-inauguration day. The rule of thumb is that translates to around, each 1 percentage point increase in tariffs translates to around 10 basis points of core inflation. So far, core CPI has gone from 2.8% year on year from March through May to 2.9 in June to 3.1 in July. Mechanically, in theory, if that relationship of 1 percentage point equals 10 basis points were to play out, you would expect the core CPI to go to 4.4% over the months ahead. Now, it's a nonlinear relationship. There are substitution effects. A lot of variables can affect this. I think by the first quarter of next year, core CPI in the U.S. is going to be at or above 4% with a relatively stable unemployment rate, which is why I keep saying it doesn't seem like the right policy move to be cutting rates with accelerating inflation, stable unemployment, but we'll see what the Fed does.
Yeah. I think you just touched on the political pressure for the Fed there, but how do you think markets are reacting to that and viewing its decisions off the base of that?
I mean, it's really interesting. There is a systematic attack on Fed independence, in my view, from the White House. I mean, we basically, now this was unrelated to the White House, was Adriana Kugler deciding not to finish her term, to leave early before the January 31st end date of her term in 2026. And so the president has nominated Stephen Barron. It looks like that confirmation process is going to happen very quickly, such that he's on the Fed board before the September 17th meeting. But remember, he's one member. The more recent thing is Lisa Cook, basically with the president saying she should resign or I'll fire her. I'm sure people have read about that in the media. But what I'm really focused on is May 2026, when Jay Powell's term as chair ends. And I do worry that regardless of who the replacement for Jay Powell will be, and it's, let's just say a 99% probability it won't be another term for Jay Powell, regardless who that person is, I worry that the damage is already being done to the perception of Fed independence. And to me, central bank independence is all about perceptions. And if we really want to be brutally honest, no central bank in the world is 100% independent. This is not a binary on-off switch, it's a dial. And so I'm not worried that we're going to wake up next June and the United States is going to have the central bank of Turkey. But I do worry that we might wake up even in January, February, March, when the next chair is nominated by the president. And if it looks like that person is unorthodox in his or her views, likely to be susceptible to political influence, that the markets will start turning the dial in a negative direction. And again, keep in mind, with inflation reaccelerating in the backdrop, unemployment relatively stable, maybe grinding a bit higher, with deficits running at over 6% of GDP every year for the next decade, this is not a recipe for dollar strength or for confidence in the Fed's resolve to fight inflation. And so once you get past that May 2026 date, the new person's in the role of chair of the Fed, even if the data validates cutting rates, if the Fed aggressively cuts rates, how are markets going to perceive that? Are they going to look at this and say, oh, it's the right call, well done, because of the data? Or is the market going to think, well, wait a minute, this person's doing what the White House wants. Is it really based on the data? Is it based on politics? And I guess, irrespective of who the US president is, the last thing I want is a Federal Reserve board or a Federal Reserve chair who takes their orders from the White House.
Maybe to stay on this topic for a second, it seems the markets are maybe getting increasingly desensitized to some of Trump's policies and actions. But what do you think will be the long-term impacts of his first 6 months in office?
Yeah, and this goes back to me saying how we're waiting for the data and the volatility I expect. I think the markets have been a bit impatient. There's this expectation that if tariffs cause inflation, we would have already seen it. And again, I think people who are investors should be good at this and should really step back and think about it. If you're the CEO or CFO of a company and look back since January 20th at the erratic policies from the United States announcing tariffs, April 2nd being the best example, you announce global tariffs, varying numbers across all these countries. A week later, you say, okay, I'm going to do a 90-day pause. You've got sectoral tariffs coming in random dates. You've got the president saying, there might be a 200% tariff on pharmaceuticals over the next 1 to 2 years. There's so much noise around the topic that if you're a Japanese auto company, for example, and at one point there's a 25% tariff on all exports from Japan that subsequently ends up being a 15% tariff, your immediate reaction to the 25% tariff is not, let's just raise prices. Your immediate reaction is, okay, if we raise prices now and the Koreans haven't raised prices and the domestic manufacturers are figuring out how steel and aluminum tariffs affect their cost base, we might lose a lot of market share. So we need to be really careful. And maybe we take the hit for a while until we know where things are going to settle out. I think part of why the data hasn't come through yet is companies are trying to wait for where it all settles. Many companies in the United States front-loaded orders from overseas to avoid the tariffs. And it's going to take time. And so how this all plays out, I think in 2026 we'll have a better view on where it's landing on inflation, what's happening with unemployment, what's happening with corporate profit margins. My biggest pushback, by the way, to asset owners and other investors who say, well, it's not going to get passed through to the customers is, well, that means the companies are eating it. And with equity markets at all-time highs, that's not being priced for corporate margins going down. That's a market that's saying corporate margins are going to be fine. And by the way, 25 to 50 basis points of rate cuts from the Fed is not going to bail you out of that story. So I think you're going to see lasting implications. I should say more immediate implications in 2026 will be more visible. But then there's one other long-term question, which is what is the lasting effect beyond 2026? And I think what you're seeing is a degradation of predictability. And this is, by the way, predated Donald Trump. It's the polarization of American politics, I think, has become a real negative factor in terms of potential future growth for the U.S. If you're the CEO of a major multinational and you're thinking about investing billions of dollars in capital and building in property, plant, and equipment in the U.S., 30 years ago, you didn't really worry about who the next president was going to be because it was center left versus center right. Now, and you've seen there's all kinds of academic research, Rand Corp has done this for years, where they kind of do a distribution of Democrats in the Congress versus Republicans. And historically, there was some kind of overlap of the tails where you might have a Democrat who was more conservative than some Republicans and vice versa. Now those curves have moved totally apart. And so I worry that that polarization is making the U.S. a less predictable destination for capital. I worry that the fact that we're even discussing perceptions of Fed independence is a negative. I get a lot of questions from global investors, and it's primarily non-U.S. investors, about rule of law in the United States. Can they depend on these kind of separate, branches of government to be checks and balances anymore? So I think what you're seeing is a kind of a critical tipping point where the U.S. is no longer head and shoulders above other economies in terms of all the factors that feed into having the reserve currency status of the world. And then one last point. Immigration, we talked about this already, but when you think about potential GDP growth for any economy, it's a two-factor equation. It's working age population growth and productivity growth. How many people work, how many hours, and how productive are they? This I've not seen written about anywhere at this point. Historically, U.S. potential GDP was viewed as 1.7 to 2%, with a lot of that coming from population growth and a good chunk of it coming from productivity as well. I worry that because of what's happened with immigration in the United States, we might have taken 30 to 50 basis points off of that productivity growth, off that population growth, which means your potential GDP growth has had a sizable downshift. If U.S. potential GDP is now 1.2 to 1.5%, that's not far above the Eurozone. It's not far above the UK, and it's well below Australia. And so I think as it relates to American exceptionalism, there are more and more kind of cracks in the story, all of which are self-imposed by policies of the current administration, by polarization, and I don't think that's come home to roost yet in equity markets.
Maybe just following up quickly on that, the end of American exceptionalism has been a big talking point recently. What is your view there?
Hard to make the call. I mean, if I want to play devil's advocate and try to be the eight-handed economist for a moment, on the one hand, on the other hand, I mean, the positive side is the U.S. is in the lead on AI, and AI is revolutionizing the global economy, and I do think the U.S. will realize more productivity benefits earlier from AI than any other economy, probably the next biggest beneficiary, China. So that would be an argument in favor of American exceptionalism, but let's be careful. That might be an argument for a segment of the U.S. equity market to outperform global markets. But if I look at the second quarter earnings season, excluding broadly defined tech, S&P earnings were up 3%. Including broadly defined tech, up 11%. If you exclude broadly defined tech and financials, earnings were negative year on year. So, when we say American exceptionalism, it might be a sliver of the American equity market that does well. And so, yes, AI is great. It's got a lot of potential. It has a lot of runway, but some degree of that's being priced in. My bias is to say this is the beginning of the end of American exceptionalism, driven in part by convergence in GDP growth rates, divergence in inflation as U.S. inflation goes up and global inflation ex-U.S. goes down, and by that chiseling away of those key characteristics that made the U.S. such a dominant destination for capital for years behind us. Now, again, this doesn't mean the wheels fall off. It doesn't mean you sell all your U.S. equities. What I'm saying to asset owners is you've done really well by being overweight the U.S. for a long, long time. I mean, if you look back, I think over the last 17 years, the S&P has compounded 10 to 11% a year. EM has compounded 1%, and Europe and Japan have compounded 2.5%. I mean, it's been a home run if you were overweight U.S. But maybe now is the time when you want to start taking a bit of that money off the table, thinking about emerging markets, thinking about what's going on in Japan in terms of returns on capital improving, and looking at Europe, where we might be at a watershed moment where Europe has finally been jolted out of its slumber by changes in U.S. policy, which might be the most positive thing coming out of the U.S. right now, is forcing other countries to really reconsider their dependency on the U.S., reconsider what they need to do on their own infrastructure, defense spending, et cetera.
And maybe if we dive a bit deeper into some of the regions you mentioned there, maybe we start with China. I think you've said your outlook's fairly negative on China right now. What do you think needs to change there?
A lot. And by the way, this is a great opportunity to point out that macro views and market views are related, but they're different, right? My favorite anecdote is since the end of 2007, Chinese GDP is up 400% and the equity market is down. Now, In recent weeks, we've seen a really raging rally in Chinese equities, a 20% gain in a very short period of time. When I look at the macro backdrop, I feel like China's in an interesting place where good news is bad news in my view, because good economic news reduces the urgency for action from the government. So for example, second quarter GDP was a little better than expected. I was disappointed in that. I actually kind of wanted a bad number, but it was clear we weren't going to get a bad number because we had all the front loading of exports, all kinds of noise in the data. The July high frequency data, the monthly data, was negative pretty much across the board. So to the extent we get more months like that, maybe that will lead to the answer to your question is what's needed. Number one, near term is a major fiscal stimulus package. I mean, China has tried for the last 3 to 4 years to address the housing crisis and the consumer confidence crisis with monetary policy. Well, when consumers have just lost 25 to 35% of the value of their home, their single biggest asset, the last thing they want to do is borrow more money. They want to build assets, not liabilities. And so I think what you need is some kind of jolt to spending. We've seen some fiscal stimulus in the last few years, subsidies for consumer durables, trade-in subsidies. Those have worked, but the problem is, if you give someone an incentive to buy a new refrigerator, you don't buy 3, you buy 1 earlier than you would have before. So you just pull forward demand. What we need to see is something that encourages people to spend money. But beyond that near-term fiscal stimulus, we need major structural reforms in China. And I think the social safety net is the top priority by far. You've got about 180 million people in China who are retirees in rural areas who live on basically about 45 Aussie dollars a month. Can't live anywhere in China on that. You need a real retirement system, a real pension plan, so people don't have to save so much of their money through their entire lives. They know they won't outlive their savings. So that to me is priority 1, 2, and 3. The next priority is basically reforming the local and provincial government funding models to be less dependent on land revenues and real estate developers. And then there's a long list behind that. But unfortunately to me, I don't see any of this stuff happening in the near term. I have to imagine that the Chinese leadership knows they need to reform, but honestly, the evidence of action is lacking.
Maybe moving on to Japan for a second, maybe being one of the surprise stories of the last few years. Japanese stock market now at record highs after decades of underperformance. Yeah. What do you think's driving that, and what is your general outlook there?
It all goes back to this governance story. I never thought I would use the words corporate governance and exciting in the same paragraph, much less the same sentence. But I do think what you've seen is, go back to the Abe administration, 2012 onwards. He had the 3 arrows. It was basically going to be fiscal reform, monetary policy reform, and structural reforms. We never got the structural reforms. We did get corporate governance code reforms. But when I mentioned the last 3 years, the Tokyo Stock Exchange has really picked up the baton and run with it. In early 2023, the Tokyo Exchange basically indicated that for any company whose share price traded below book value for a sustained period of time, they had to develop a capital action plan to resolve that. You've now seen, and by the way, the theoretical guideline was if you're a prime listed company, you had to do this. There's also a standard listing, which is a less prestigious listing. We saw a couple hundred companies downgrade their listings to avoid doing this, but of the remaining companies, well over 90% have now developed those capital action plans. They're leading to more buybacks, higher dividends. And the whole idea here, by the way, is when I look at Japanese companies, part of why their returns on equity are so low is they have too much equity. After 30 years of no inflation and kind of developing a fortress or a siege mentality, companies just kept accumulating cash they couldn't deploy. So giving that cash back to shareholders lowers your equity value, but it raises your return on equity. And I think what's important there is from an economic perspective, you get the money to people who can deploy it somewhere useful. And so that's been really positive. The corporate takeover code changes are really important. Over the last year, there was this saga between a company in Montreal called Alimentation Couche-Tard that launched an unsolicited bid for 7&I. Couche-Tard ran Circle K convenience stores in the US, 7&I ran 7-Eleven. Ultimately, the bid failed. But what's totally different than in the past, in the last 5 years, the rules changed on the takeover code such that a company that receives an unsolicited bid cannot just ignore the bid. They have to form the board committee to review the bid. They have to alert their shareholders of the bid. They actually have to consider what's in the interest of shareholders. What you saw in the last year was 7&I ended up disposing, selling off non-core businesses, raising a large amount of cash, distributing that cash. They changed how the company worked because of an unsolicited bid. 10 years ago, that would not have happened in Japan. And so I put all these things together and I mentioned, deflation is dead. This is also important. From 1999 to 2021, consumer prices in Japan went up 1% in total in 22 years. Since the end of 2021, prices are up 12%. Consumer psychology is changing, wage demands are changing. So I think Japan is becoming a more dynamic economy. Make no mistake, it's Japan. It takes time. But I think for investors with a long-term horizon, this is somewhere where they should have capital invested. I think you're going to see more private equity activity in Japan because companies are basically going to have to respond to private equity bids. It won't be barbarians at the gate, US-style PE, but I think you're going to see improving returns on capital as PE takes over companies, and I think you're going to see public equities work on the back of that.
And maybe then just moving to Europe as well. I think you've said that the EU's on the cusp of a watershed moment. What do you mean by that?
And I should have said maybe possibly. I just don't want to I want to avoid becoming too optimistic too quickly. If you look at Europe for decades, it's been hard to be bullish on Europe. The demographics, again, I mentioned what's the GDP model, working age population growth and productivity. In both cases, working age population, lower in Europe than the US and Australia. Productivity, lower than the US, materially lower. What I think might be changing is because of the threats of US withdrawing its protective umbrella for NATO to some degree, or at least the perception of a withdrawal, Europe has been forced to engage in defending itself, investing more in infrastructure. And let's just use Germany, because Germany is the focal point of the story. Germany has basically agreed to 5% of GDP on defense spending, up from 2%. 3.5% of that 5% will be traditional defense, 1.5% infrastructure. Germany's committed to a 500 billion euro infrastructure program over 12 years. Germany is allowing now the states basically to run a very small deficit each year versus no deficit. You put all the measures Germany has agreed to together, and you basically get to as much as 150 billion euros per year of additional spending and borrowing. That's basically 3.5% to 4% of German GDP. That's 1% of Eurozone GDP. This is an enormous amount of money. Now, typically government spending more money, borrowing more money does not get me energized. What I think is different here, though, is if you look at one of the biggest differences between the US and Europe for decades, it's been the size of the tech sector and the success of technology and the innovation in the US. There are cultural differences that still need to be resolved in Europe in terms of qualitative things like, in the United States, it's almost a badge of honor to have started 4 companies that failed, but if you get the 5th one right, you're a hero. That's not the case in Europe. Europe has other issues, depths of capital markets, et cetera, but what's been missing is the defense spending engine that has really lifted a lot of the US fortunes on tech. Even reading an article today in this month's Atlantic magazine about SpaceX, how it was basically bailed out by Pentagon spending and DARPA. DARPA is the Defense Advanced Research Projects Agency. If you look in the US historically, GPS, internet funding, autonomous driving, voice recognition, all of those areas got critical funding from the Pentagon. If Europe is now realizing they need their own defense capabilities and they don't want to be totally dependent on the United States, they're going to spend it in Europe with European companies. I think over the next decade, and it is a decade story, not a 2 to 3 years, you're going to see innovation benefits. You're going to see bigger multiplier effects if Europe gets this right. And this could be a watershed moment. And by the way, near term, you will see benefits as well of taking excess capacity in the industrial sector and transitioning it to military equipment. That will happen. But for the really important stuff for Europe's defense in the long term, you're going to have that tech innovation spend. And I think we're going to see it.
And finally, there's probably plenty for investors to be worried about right now, but global markets have shown quite a lot of strength. Ultimately, do you think this will continue?
Well, we started with volatility. I think it's interesting. When I've watched investors year to date, initially in the early part of the year, there was a lot of optimism in the US because a new administration that had talked about cutting corporate taxes, cutting personal taxes, deregulation. But the new administration has also been very honest and open for a year or more about raising tariffs. Most of the investors, if I had to quantify, 80 to 90% of the investors I spoke with globally said, the tariff stuff's not going to happen. It's a negotiating position. It's bluster on the campaign trail. Don't worry. You're too worried. Well, I was right about that. And our geopolitical advisory business has been pounding the table on this, saying you really need to believe these tariffs. But once the tariffs happened on April 2nd, markets really were unnerved, right? It was this wake-up call, this splash of cold water, and people said, wait a minute, this is real. And markets sold off hard. And the dollar sold off, and the bond market sold off. But then April 9th seemed to validate the optimism, right? Because on April 9th, Trump said 90-day reprieve. Investors are like, I knew it was all a negotiating position. It's not going to happen. Well, it's happened. It just hasn't shown up in the data. And so when I worry about the markets, what worries me is investors have almost gotten into this mode of good news is good news and bad news is good news. There is no bad news. Labor market's weak. Well, that means the Fed's going to bail us out. Tariffs still haven't shown up. So people are just assuming, well, the data's not bad. It's not going to be so bad. And so I think the higher the valuations go, the more optimistic people get about these markets, the more worried I get that there's room for an air pocket underneath. And so I would focus on the Fed. I do think this whole topic of Fed independence is underappreciated in the markets. I think the bond market and the currency market are taking it way more seriously than the equity market. And it's just important to recognize if you get a tail risk scenario where an unorthodox central bank chair is appointed at the Fed and gets confirmed by the Senate, which I think is highly likely that whatever candidate the president nominates will be confirmed, I think you could have a discontinuity in the market on the bond market side. And what we saw in October of 2023 is when the US 10-year Treasury yield hit 5%, equity valuations became a lot more problematic because of asset allocation flows. I think that could be a real issue, and it's primarily the US that's the focal point. But make no mistake, if the US has a 10 to 20% downdraft or drawdown, I think you're going to see downside in other markets. I just think it will be less severe. So I think from a protection of capital perspective, reallocating on the margins to other markets outside the US makes sense. And frankly, reducing US dollar denominated exposure on the margin also makes sense. So it's not some kind of keep you awake at night apocalyptic scenario. It's one that's reasonably predictable and foreseeable. I just think markets are underestimating what might happen and how important it might be.
Thanks for joining us today, Ron.
Pleasure. Thanks for having me.
Thanks for watching. Make sure to go to our website, our YouTube channel to get more great videos.